This year, the San Ramon real estate market is starting off in a better and more primed condition than last year. I'm Tony with Clarkson Santoro, and this is our real estate update for the week of Friday, January 12th. I know that selling or buying a house is stressful and can be very confusing. So we do these weekly videos so you can know how the market is affecting you as a homeowner thinking about selling, or as someone looking for a house that you'll love to call home. Let's start off by looking at how the market performed this week. There are currently 11 homes active on the market, which is almost twice the number of homes as last week. It's still a very low number though at 11. The average asking price is $1,760,000, down from last week's average asking price of $2,034,000. 2 homes went pending this week, but none went pending last week. The average asking price of this week's pending property is $1,399,000. And no homes sold this week. 2 sold last week with an average sales price of $1,405,000. So, okay, now we know how the market performed this past week. So let's talk about how the broader trends that provide insight into the overall health of the market and its potential future direction. Before we proceed, if you find this information helpful, you can subscribe so that you don't miss out on future updates. And why not share it with a friend as well? Everyone deserves to be in the know about their local market. All right, let's take a look at those indicators, shall we? Inventory levels were into the single digits over the Christmas and New Year's holiday weeks. As is typical for this time of year, inventory is slowly increasing from the annual low point in the market. Here's where that low market point was. 11 homes is still very low, which was the trend for the market all of last year. With inventory doubling in the past 2 weeks, it's no surprise to see that our year is starting with a low turnover rate. A week or two of turnover rates below 1 per month are not unsettling and tend to track with small jumps in inventory. But if the low turnover rate lasts more than a month, that is when I would say that the market is really slowing down. The amount sellers are receiving for their homes has come down as well, which is typical also for this time of year. Sellers are now receiving about 1% below their asking price. But to put that in perspective, sellers were receiving 4% under the asking price at the start of last year. So we're still sitting well above how we were at the beginning of last year. We will see if this year follows the same trend with offer prices picking up by late February. Prices have also been on a consistent downward trajectory since about October. November or October last year, where they sat above 2 million. When you look at this chart and consider the average price is down now about 400,000 below last year's high, it might feel like home values are starting to crash. But the reality is the values are holding, if not coming down just slightly, but nothing like this chart represents. Rather, the chart really points to the fact that the smaller homes and more affordable homes are selling, and larger, more expensive homes are either not selling or just not being listed at all. I do think prices will start edging up in the coming weeks, but we aren't likely to see a spike in sales prices before the spring if those price increases do come. The high-tech equity market continues to improve. The Q fund increased 4% over the past month and 12% over the past 3 months. The strength of the tech industry leads to consumer confidence in our market. That is especially noticeable in our largest buyer demographic, namely the tech professionals looking for more affordable housing in a safe and well-appointed city that competes with the peninsula lifestyle without that peninsula price tag. Buyers coming out of the Silicon Valley tend to have large amounts of their down payment cash in their stock options. So tech-equity fund growth means down payment fund growth for them. Interest rates were trending really well at the end of the year. We were in a downward slope that started in October, and we saw a reduction in rates by more than 1% by the end of the year. The rates have since leveled off and are creeping back up ever so slightly, 5 basis points in the past 2 weeks, but we are hopeful that we will begin to trend down again, if not as rapidly as we saw the last quarter of 2023. Interest rates will remain the one major indicator that will hold the market in check until they come down more dramatically. Overall, the start of the year is more promising than last year, and our market held strong last year. It was a slow year, but I think we are poised to start this year a little quicker, and we'll see a little more activity in the market in 2024. As long as the stock market, and especially tech equities, holds strong and inventory doesn't increase drastically, then home values will stay strong in our area. Thank you for joining me for our weekly update. We hope the summary and commentary helped you understand how our market is impacting your options. Don't forget to hit the subscribe button and ring the notification bell so you can stay informed on how the market is shaping up this year. Have a safe weekend, and we'll see you next week with a new update.